It's Wednesday, March the 15th, and let's just say our phones have been ringing.
We're here. You'll see something a little bit different here on the desk. We felt that important that we would do a video and talk quickly with you about what's going on with the Federal Reserve, what's going on, especially in the banking and the three banks now that are in financial distress. And you see clutter in front of us because of actual notes that we've been making early this morning of things we want to bring to you.
Yeah, I started on an email yesterday, and after an hour and a half into the email, I said, you know what, let's just do a video and get it out as quickly as we can. I think that, unfortunately, what we're witnessing is bringing back very bad memories.
Yes.
And those bad memories, of course, date back to 2008. And the questions that we're getting through email and through phone calls are, is this 2008 all over again? They do have something in common. Both situations are due to bad management.
Yes.
And so I think that's really where the similarities lie, because 2008 was a different beast altogether. I'll take you do a quick history lesson. 2008 was, of course, the mortgage crisis. Many people who had no business owning homes, having mortgages, were given mortgages. And then those were funded by adjustable rate mortgages, which means as rates either go up or down, so does your mortgage payment. And not only did they give loans that way, or those were the most popular ways to do them, they also repackaged all of these loans up and sold them as investments to the same people who were making the mortgage giving the mortgages, I should say. So not only were they issuing mortgages that were going to default at some point when interest rates went up, but they were packaging them as an investment so that when the defaults started to occur, the investment blew up. So yeah, it was a double whammy effect. So what we learned from 2008 was making sure that banks had adequate liquidity. There was the Dodd-Frank laws put in place, and at least up to now that the liquidity issues have been taken care of. I don't think the two are the same except for mismanagement. Now let's go to present day, and present day being Silicon Valley Bank, Signature Bank. We have Credit Suisse today coming unwound. What's going on there?
All right, so let me just read to you so you can have a real quick understanding of what's going on. And Gib mentioned, we got three major banks that are in the news today. SVB, which is the Silicon Valley Bank, it's referred to SVB. They had unrealized losses. All right, now follow with me what we're saying and listen to the words. Unrealized losses for large holdings of U.S. government debt and mortgage-backed securities purchased when interest rates were low, and then when interest rates began to go higher because of the Federal Reserve increasing interest rate, the value of those loans, the value of those assets went down, and then the financial sheets got in bad shape. Bank customers got concerned, and then they began to withdraw money. Money's going out the door, and on paper, their assets are having less and less value, and it creates a run on the bank.
So think about, if you've listened to our show, if you've seen these videos, we've talked about the difference between the 2-year Treasury and the 10-year Treasury, always signaling a recession.
Right.
When they invert, and that is what has happened really for the better part of a year, the inversion of the 2 and the 10, meaning you get paid more for a 2-year Treasury than a 10-year Treasury. So when you have a situation like that, exactly what you said, John, the face value of that bond devalues and it's worth less. It's not worthless, it's just going to be worth less than you anticipated.
And if you would hold it to maturity, you would have the full value. But you had a run on the bank of customers withdrawing money because of concerns coming from primarily the freedom of conversation that can occur through internet, through cell phones, through all kinds of tweets and everything. And so that created, here's the word, fear, and the fear then, because of poor management in that particular bank of what they bought, then created the problem for this bank. All right. The second bank, Signature Bank. This was one of the few financial institutions that had opened its doors to take deposits. Write this down. Crypto assets. And what have we been saying about crypto assets? We don't want to even talk with you about that because of the volatility. And it is a bank that entered into the business in 2018. And then when FTX began to fall out, crypto assets collapsed. So here's a bank that has based its financial sheet on crypto assets, and crypto's crashing. So what's going to happen? I mean, it's just 1 + 1 is 2, and this bank then is what's going on in that bank. And then the final one was overnight with Credit Suisse. Now, Credit Suisse for 6 months
or a year, they've had difficulties. They've had liquidity issues. In fact, they've had Saudi National Bank as their sugar daddy, who has been funding the bank. And sugar daddy yesterday said no more. And now you have Credit Suisse down. Last time I checked, 27%.
So you had all of that going on. Let's come back here to the United States with the two banks, Signature and SVB, and let's talk about what the Federal Reserve and the Treasury and everything did. Everybody knows about the FDIC insurance, the $250,000 limit. Well, in order to stop a run on the banking system, the powers to be, the Federal Reserve, the Treasury, the FDIC, all came in and said with these two banks, and in effect implied with all banking institutions, they're going to cover all deposits.
Correct. Which then creates a moral hazard, but that's a whole
different subject.
That's a whole different discussion. So go ahead.
Now we're in the swimming pool of worry about contagion and financial banks and the stock market at the very time that the Federal Reserve has said it is going to increase interest rates next week by 50 basis, or they hadn't said it, it's implied it was 50 basis points, and now the discussion is, will it be 25? Will they pause? Will it be a 50? Will they keep going? So you got the Federal Reserve over here with inflation, and inflation numbers came in better yesterday, Monday.
The PPI numbers, producer price index, came in much better than anticipated.
Right, it came in at a 6% rate yesterday with an expected rate of 6% where it came in. Actually, the stock market yesterday, the S&P was up 1.7%, the NASDAQ was up 2.3%, and even regional banks that got caught up in early on of what's going on with those two U.S. banks, they began to rise. But then you had Credit Suisse occurred, and now we're all into the deep end worrying about the financial crisis, what's going on, and what the Federal Reserve is going to do.
So we've been saying for the better part of 6 months that this was going to be a hard landing. You can't ratchet rates up as rapidly and double mortgage rates in such a short period of time and not have a hard landing. And that's what we're witnessing right now. And so things that have weaknesses are going to show themselves. Those that are correctly funded and doing the right thing as far as what they're purchasing for their protection are going to do just fine.
Right. Now, that doesn't mean your accounts are not going to go down.
It does not.
The accounts are going to go down in value, but they aren't, we believe, with how we position it, again, in the shorter term treasuries, high quality dividend paying stock positions and high quality ETF positions, that we're going to weather this storm. And with the weathering storm, the interesting thing, we've already had a conversation with a client this morning, and the question he posed to us was the correct question. At what time do we think we want to enter back into the stock market? Because will this create an opportunity? And whereas up until now, we have not been able to say to you when it is, this very well might create an opportunity.
Because we have been saying that we're going to test the lows that we saw back in 22, which were in October on the Dow and the S&P. And once we eclipse that mark, I think we're getting back into the territory where it makes sense to buy back in. So whether that takes a month, whether that takes 2 months, we don't know. but we do know there are going to be opportunities that present themselves. Who would have thought yesterday or 2 days ago that we'd be talking about big banks as a possibility of a place that we might go to purchase equities?
All right. Want to reiterate again what Gibbs said, and said so correctly for you, that this is not a 2008 crisis. Again, 2008 was a crisis worsened by the financial institutions that held the mortgage-backed securities to people that didn't have the ability to weather storms. This is not that. Securities are the Treasury securities that are being held. It's a timing issue. It's the inversion issue that's creating a problem. It will probably, in all likelihood, in our belief, create a bumpy to a rough landing. But we're going to work our way through this, and opportunities are going to be presented to us, we believe, in a reasonable period of time that we can take advantage of.
Great.
That's where it is. The word of the day, don't panic.
I think that's two words.
Okay, 2 words.
Yeah, it was 2 words.
2 words of the day. Don't panic. We're looking at this. We're talking to folks on it. We're talking to each other. We're meeting with a lot of folks to be sure we understand what to do. And if you have any questions, you can give us a call. We do it because it is your money.
And your money matters.
See you next week.